Welcome to the C-Suite Series presented by Channelchek and Noble Capital Markets. Noble is an SEC-registered FINRA-licensed broker-dealer and the source of the equity research available on Channelchek. Of the 6,000 small and micro-cap companies listed on the site, today we're featuring InPlay Oil. Michael Heim, Noble's senior research analyst covering the company, will be interviewing CEO Doug Bartole. Afterwards, he will be joined by Michael Kopinski, Noble's Director of Research, to discuss the key takeaways. As a reminder, Michael's research is available at no cost on Channelchek. Just type in InPlay Oil in the top left Company Data section. And now, here's Michael and Doug.
Doug, I've got a lot of questions, but before we jump into them, why don't you just give us a little background about how InPlay came to be?
Well, it's a pleasure talking to you and seeing you, Michael. Even though it's different circumstances, I honestly like to tell you that this is my first real Zoom interview, so looking forward to our discussion. InPlay. So we successfully sold a company called Vero Energy that was previously I was the president of in 2012. At that time, we started again pretty much through 13. We were looking for capital partners and for assets. There was not a lot of good assets on the market through 13, so it took us most of the year to figure that out and find the capital partners that we wanted to deal with. That started coming together at the end of 13 and into 14 when we started raising the money and purchasing some assets. So we purchased approximately 1,400 BOEs a day in 2014. Of course, WTI was $1,900 through quite a bit of that year. We grew it up to 1,800, 2,000 barrels the odd time, but generally stayed flat in the 14 to 1,600 barrel a day range through 15 and 16. And 15 and 16, of course, we saw the drop in prices where it hovered between, $30 and $50 through that time frame. We knew we had to get bigger, and through 16 we were looking at a lot of options. In the end, we ended up announcing in early fall a reverse takeover of a publicly traded TSX company. We raised $70 million and we bought an asset in the Pembina Cardium play from another company. We started trading November 10th on the TSX under InPlay Oil. That's where we came out at about 3,500 barrels, where we've grown to 5,000 barrel day average in 2019, predominantly through the drill bit and specifically within our means and spending cash flow. So again, very, very strong growth, organic growth with a few tuck-ins along the way and a few strategic sales.
Now, when people think Western Canada, they might think of heavier oil, but that's not the case with you. Why don't you talk a little bit about the plays that you're active in?
Yeah, I mean, our primary play, Michael, is the Cardium play. So both in the Williston Green and the Pembina fields has been where we are. So this is a conventional light oil play. These fields were discovered in the 50s and 60s, delineated through the 70s and 80s, with mostly vertical wells, water floods put in place. Now, over this time frame, there's been a low recovery factor. Basically, not a lot of oil recovered from the amount of oil, the original oil in place. We've been able to go back in with horizontal multi-frac completion technologies on our wells and access a lot of this oil that hadn't been recovered and increased the amount of oil recovered out of these old plays. So it's been very interesting. We're a strong technical team that has allowed us to go back into these plays, use our technical expertise. We've been forefront in many of the drilling and completion technologies on these plays. We also have a shale play called the East Basin Duvernay Shale. This is a much longer play. We have not spent a lot of money on it to date. As most shale plays in North America, we believe it takes a lot more higher oil price for us to get involved into that play or get more aggressive with that play. So hopefully it's a future play, but there's a lot of oil in place and it's very, very intriguing. And hopefully once you start working on that play, you can get the cost down. It's going to take higher oil prices to start, but get the cost down and start making that as attractive as potentially the Cardium play.
Certainly a strength of InPlay is that it is a low-cost producer. How are you able to have be so attractive in terms of your cost relative to what some of the other producers show?
Well, we have a strong operational team, both the technical side in the office and a very, very strong team in the field. So operationally, we're on top of these plays. We've got decades of experience. In fact, our combined experience with our executives is approximately 150 years of industry experience, with a lot of it in the Cardium. And we're focused in the Cardium. So that focus, the strong team, the strong technical capabilities, those are the keys that allow us to have such good cost structures. A couple of the little pieces are we control most of our operations. We control the infrastructure, and where we don't have control of infrastructure, there's generally really strong third-party access for getting product removed from the areas.
Now, even being a low-cost producer, you had to make some adjustments when oil prices dropped from $40 to under $20 last spring. Tell us what adjustments you made.
Well, it was quite simple. I mean, it looked really, really bad. We have never seen a price drop. I've been involved in this industry for close to 30 years. I've never seen the price drop so quickly, so drastically in a short period of time. And with all the considerations going forward, you had to be prepared for $30 or less for a longer period of time. Right at the end of March, we hit it hard. We started with 20% reductions in salaries, both in the field, well, in the office to start, and then followed up in the field. With that, we went to all of our vendors, our partners in these operations, and we asked them to dig deep. And I'm very pleased to say that the majority of these people really did dig deep, and they came to the table. I mean, they realized the situation that was there as well. And you know, again, we're very pleased with most of the companies that we have strong relationships with. Then discretionary spending. There was no servicing of wells that went down. There was curtailment started to happen in May, June, and July through July. We actually shut in production of really high op cost areas, to not lose money. So you put all those factors together, and we actually had lower op costs in G&A with with our lowest production quarter in our history. So it was we're nimble, we move quick, the decisions get made here, and we act on them quickly, and that's what occurred.
That couldn't have been an easy decision to curtail production and shut in production. You had a pretty strong record of continuous production growth. How did you go about making that decision?
Honestly, it wasn't that hard of a decision. Just looking at the where things were going, the storage filling up so quick, the COVID demand drop, and the OPEC disagreement, the OPEC plus disagreements, it was looking pretty dire. There was not a lot of reason to sell a lot of production and your proved developed producing reserves at a loss or close to a loss. And we were pretty much the same as just about the entire industry where we curtailed. So again, quite a simple decision when you really look back at it. We did the right things.
Now, the good news is that oil prices have come back a little bit, maybe even a little bit quicker than some of us expected. How have you been able to respond, or how have you responded to the strength we've seen over the summer?
Yeah, so we expected oil prices to stay in kind of this mid-30 range through the third quarter, and then potentially you start getting 45 plus in the fourth quarter originally. It came back over $40 quite quickly, which brought back the curtailments, and now sooner than we expected. So now we're probably a little more range bound than we were expecting. But with that said, we started bringing back the production in July, and really starting to hit it hard in August, where to the point where probably 90%, working our way to 95% of our production on prior to pre-COVID curtailments and shut-ins. Now, we do have some wells that we started bringing on with workovers that have been down. There are still some wells that just do not pay out in the 6 to 9 month time frame that we're typically looking at, so it still needs higher pricing to do that. We do have some non-operated production down, but in general, things have been coming back nicely, and we're very, very pleased where we sit today, and things are looking positive in the third quarter and going into the fourth quarter.
Second quarter results were actually pretty good, all things considered. You mentioned that some of the costs you had kind of deferred, the discretionary costs. Should we expect to see those coming back in the next couple of quarters?
Yeah, that's a good question, Michael. I imagine you will see these costs coming back. There are pressures for some costs to increase. We do expect, as pricing increases, for the cost to come back across the board. You got to remember, we cut to the bone probably as low as we'd want to cut, and we need to increase some of those costs as we go forward. With that said, I still firmly believe that you're going to see somewhere between 10 to 20% cost reductions from pre-COVID levels until you get maybe into the $70+ WTI range, when all bets are off because services get busy and they have a lack of people working in the service industry right now. So to try and get people back is going to cost some extra cap, some extra funds. So, but things are looking pretty good through this. We got pretty efficient through 2015 and 16, and I think we have got more efficient in the last 3-4 months.
Now, along with earnings, you announced a new credit facility, which may have been even more important than the earnings. Can you kind of tell us about that?
Yeah, we're very pleased about that. Now, like, to be clear, this is a non-binding letter of intent at this point in time with the Business Development Canada. So it's a Crown corporation in conjunction with our syndicate of lenders. Now, the key to this is it's a second lien 25 million term loan that's available to us. And that term of 4 years is the key, where it allows us to get back to pre-COVID production and reserve levels. We believe it gives us the time to be able to do that. For a small junior company to get a second lien loan is virtually impossible. And if you do get one, the cost structures of that are typically very, very obscene. So yeah, this is a spot where we're very, very confident that now it's going to allow us to do the right things and to get our production and our reserves back to those pre-COVID levels and 5,000 barrels a day like we averaged in 2019.
Previously, you've always stressed the importance of living within your cash flow. Do you think you can get to that point again in the third or fourth quarter?
Yeah, I mean, it's going to be a balance between prices, commodity prices, cash flow, capital spending to keep production up and prove developed producing reserves up, which are typically the main indicator used in our lending value. So fourth quarter is getting closer, but in 2021, I would fully expect that you will see us spend pretty close to cash flow and getting very, very close to our 2019 levels if we do not get there. If we don't, potentially we will get there as well.
Traditionally, you haven't done a lot in terms of hedges with prices a little bit higher. Are you a little more tempted to start locking in pricing?
So we've been layering hedges, mostly short term on the oil side, 3-4 months in length. We have started adding a few longer term hedges. These are specifically collars. So this is where we put a floor on the price on the current future price, and we got a ceiling price that's a bit higher than the future price, so it allows us to come into some upside. We have been doing longer term hedges on the natural gas side, as the natural gas has been a lot more robust over the while. But we've been layering in hedges continually since the second quarter of this year.
Now that your liquidity position is a little bit better, could you see yourself making any more tucking acquisitions, or is really the focus going to be on drilling going forward?
So I would like to be able to do some more tuck-in acquisitions. We're always looking at stuff. You have not seen a bunch of tuck-in acquisitions yet. I believe the key issue around that is we're a little bit light on equity. Debt is difficult to come by. You got to work with your lenders on everything. But with that said, we are seeing certain acquisitions start to come down in price, where they're looking like they might be equivalent or even lower than what you could add production and reserves for through the drill bit. So it's a very, very intriguing way to go. And we hope to be opportunistic and be able to take advantage of that as we move forward.
How about the other side of the coin? Do you have any non-strategic assets that you could perhaps consider selling?
We do have some, and over time we've looked at selling some of them, and we have had some people interested. But in general, again, with that lack of capital in the oil and gas industry right now, we find that most of the guys looking for assets are wanting to pay rock bottom prices. Barely cover your lending value on them at this point in time. So I think as you see more capital, more funds come into the market, you'll see potential for that to occur. But so far, the M&A activity has been, a slow prospect right now. But it looks to be speeding up a bit, and I think that occurs with the increasing commodity price and looking like we're going in the right direction.
So it does seem like things are getting back in the right direction. Oil prices are close to where we were pre-COVID. Talking about production coming back online and getting to those levels. But your stock price that was more around 50 cents pre-COVID is kind of stuck around 15 cents. Why do you think the stock price isn't responding to the improvements in company fundamentals in the last couple of months?
Well, honestly, I look at my peers and I haven't seen the peers move very much in the last little while as well. Specifically the junior and intermediates. There has been a lack of capital returning to the market, specifically with institutional funds. And if they are looking, they're looking at larger cap, more liquid funds, index funds, having to buy that. On this junior side, we've seen some retail people buying. We've seen some speculation. Our liquidity has been as good as it's been throughout our course of our publicly traded company. I look at it and I think there are a lot of people that are just sort of waiting. When is the time? We got to $43 here in the last few weeks. You had $45 future pricing for 2021. But people want to start seeing that and starting to realize that before they jump back into space a little bit quicker. There doesn't seem to be a hurry or an urgency to do that. With that said, with our debt levels and our debt to cash flow, increasing commodity prices, getting our cash flow back up, you're going to see our debt to cash flow drop significantly. And this is where that liquidity piece, once we get that taken care of, is going to be the key. And we're going to have huge torque to the upside when the commodity prices do turn and do come back. And again, I'm talking to people now that are starting to get a little bit more bullish. And I mean, I'm specifically optimistic. I'm more of the second half of 2021 going into 2022 with the lack of capital spending that's occurring in the world right now, that we're going to see supply and demand come together quite nicely, even if there are some increases throughout the world, where we're going to see the oil price start to work really, really positively in our favor. And of course, the markets, they tend to react quicker or earlier than the actual commodity price move. So that kind of gives you an idea of when it could occur, that we start seeing people getting back into the energy industry.
Sure. Well, we're getting a little tight on time, so I'll just sum up by saying thank you for participating in this, Doug. It's been great to hear a little bit more about the InPlay story.
It's been a pleasure seeing you there again, Michael. We will talk soon.
Mike, this seems like a pretty straightforward play here, but you asked a couple of questions about liquidity, and so I was wondering if you can just review for us the debt leverage that they have currently, because it sounded like it may have been a concern of yours at one point, and what your thoughts are about the leverage at this point.
Yeah, for a small company, they do have a good amount of debt, about $55 million or so. That leaves, I think it was $6 million on their line of credit available. So getting this new $15 million credit line or credit facility was very important for them. And the fact that they can get it at real good terms because it was government sponsored is also important. It does really give them the liquidity they need to provide to fill the gap between where they were in terms of production and where they will be going forward when things get back to normal. So it was a very important move for them, and I think it'll be very helpful to them.
I liked your question about the stock price, because it's curious. It sounded like everything's pretty much back to normal, but the stock price. And so do you think that it might be that investors are a little worried about the volatility in commodity prices like we saw in the last few months back, or do you think there's something else at play here?
Yeah, that's always going to be could be an issue. These are stocks that trade based on commodity prices for the most part. Yes, things have come back, and they're talking about production levels getting to the pre-COVID level. But it's one thing to say it, and it's another to actually demonstrate that that's in force. So it just takes some time of some solid results for people to get back into the stock market with the stock.
Well, Mike, it was a great company, and I really appreciate you bringing them to us. Thank you.
My pleasure.